Hi, I'm Rachel Hawkins with Angler Insurance. I work with employers who are frustrated and feeling the rising costs of healthcare. Lack of transparency, little control over how your dollars are being spent is frustrating. Today, I am joined with Ryan Audin from Roundstone, who is a leading provider of medical captives. In this webinar, we're going to show you three things. The first thing is going to be how alternative funding can give mid-sized employers like you control, savings, and data. The second thing is how companies like yours are saving about 20% or more without sacrificing care of benefits. And the third is, what is a medical captive and is it the right fit for you? Here's the problem. If you're fully insured, you're most likely stuck in a one-size-fits-all type plan, and you're not getting the data that is backing up your claims. It also isn't giving you the control, and you're getting annual rate hikes without an explanation. You're paying more and more year after year, and the worst part is if you have leftover money, you're not the one keeping it, the carrier is. So, if you are looking at trying to take control of your health costs, this is a great strategy for you to consider. It's not just damage control. We're really here to try to have a long-term strategy. So Ryan, can you explain to our listeners what a medical captive is and why they should consider this their next renewal?
Yeah, thanks, Rachel. Thanks for having me. What is a medical captive? So I would say a captive is an insurance company of like-minded employers that band together to share in the risk of their healthcare. And they've been around for years. Our market, so we go down to probably 25 eligible up to about 1,000. So the captive is in the middle market where groups traditionally haven't had the ability or the risk tolerance to self-fund. So by banding together with a bunch of other employers, we're able to purchase what's called stop-loss insurance in bulk and smooth out renewals for smaller companies. So kind of how it works is it's a form of self-funding. You get access to all of your claims information, your drug spend information, and because you're in a large group, we like to say it's kind of like joining a Fortune 500 company with thousands of employers. You're able to stabilize your renewal and save multiple different ways. So is that kind of what you're looking for, Rachel?
Yeah, absolutely. I think that for someone that's fully insured, sometimes they're even looking at a collaboration plan that's an association, that they're pooled with other employers, and they're like, hey, I'm going to get a better rate because I'm pooled with these other groups. It's similar that a medical captive is pooling with other employers, except you're self-funding. So you're not self-funding on an island alone. And that extra layer provides protection for these groups that tend to be smaller, that can now move to this type of model. So I agree. Did you have any visuals to help kind of show our audience today on how a medical captive can break down?
Yeah, let me show you how it works. So the old model, which you talked a little bit about, is traditionally 100% fixed cost. So we like to call that renting your insurance. You pay the insurance company every month, you never get anything back. The new model or the captive model is kind of broken down in what we affectionately call our layer cake. So this is the mechanics behind the scenes, how things are funded. So you'll see the first big blue box, I'll call it, is a claims account. So in a self-funded model, the employer takes on some risk. So they pay their own claims. That is traditionally smaller claims that they pay throughout the year. The benefit of this is they keep 100% of what they don't spend in that claims account. The green layer, which is a shared risk layer, if you will, We take a portion of the insurance from thousands of employers and we seed it into this captive layer. Whatever's left over in that layer at the end of the year, we pay back to the members. The third layer, which is the orange layer, is what we call reinsurance. So God forbid, if they ever have large claims, we purchase a reinsurance, stop loss insurance that protects us and the captive against high cost claims. So behind the scenes, this is how the funding works. At the end of the day, there's really three ways groups save. So how we come up with our average group saves 19 to 20% a year versus the traditional market is they keep what they don't spend in that claims account. They get a portion of what's left over in the captive, whatever the captive doesn't pay out in claims at the end of the year, we pay back to the members. And then the third way, which we haven't really talked about, is drug rebates. So in the traditional model, if you're fully insured, level funded, most employers don't know what a drug rebate is. So in our model, everything's passed back to the employer on a quarterly basis. So if you add those three up, those are the three ways groups save, which works out to 19 to 20% a year in savings. So does that make
Yeah, I
sense
think
how
that
that all works?
absolutely. And I think that you brought up a really good point in regards to the pharmaceutical rebate. So we have a manufacturing company who moved from fully insured to the medical captive with you guys through Roundstone just over 2 years ago. They were traditionally seeing about an 18% rate increase prior to that being fully insured. And since moving to the captive, we've been able to take some of that data, make some changes. One of the things was pharmaceuticals. And so last year, I remember I told the owner, hey, you're getting your pharmaceutical rebate, and it was just under $21,000 that they received from the pharmacy benefit. And that, in addition to distributions and the unused claims, these savings really tend to add up. And I think when we are working with companies and they start to understand these strategic ways of how we can control cost thanks to the data, it's going to yield long-term results. And one of them is this same group as the case study that I'm referencing. This last renewal, they renewed March 1st, 2025. I was able to give them a 0% renewal increase. And that's all because of the work that we did in funding their plan correctly. And that is not only huge for their bottom line as a company, but also the employees being able to retain the same benefits and not have a rate increase. I mean, that's really unheard of in today's industry. And it's because of these strategic steps that we're taking. We are really trying to put in a 3-year, 5-year game plan. So I think that you addressing those three topics is very important. Can you also touch on what a spec deductible is? We had another client who kind of had a shock claim, a catastrophic claim, and they were wondering, okay, how is this going to affect me? So we have these kind of parameters put in place to safeguard the client. What would that look like? And can you explain that to our clients?
Yeah, that's a good question. So there are protections in place, and each group purchases what's called stop loss insurance. There's two types of stop loss insurance. There's specific stop loss and aggregate stop loss. Each group is underwritten individually. They all have different deductibles based on the size of their group. But a specific deductible is for shock claims. So they purchase a stop loss. Anything that goes above a specific deductible is covered by the captive and then covered by reinsurance. So going in, they know their maximum allowable cost for that employee for the year. And then we set a deductible for that group, and that's the worst case scenario on an individual claim. You also purchase what's called aggregate insurance that protects the company for the year. So they'll have a number that they're self-funding as a company for the entire year, and then you're buying aggregate insurance. If anything goes over that for the year, they're covered 100%. So when you mention there's some training wheels or shock absorbers that are put in place with the captive that protect them both from individual high cost claimants and for the year. And then you couple that with adding the captive layer that really protects them and smooths out their renewals year to year. So you have those three kind of components in place that protect them every year.
Yeah, I think that that's helpful. Sometimes when I'm talking to newer business owners who aren't really understanding the complexities of healthcare, because it's very confusing, they don't realize that these fundamentals are already in place in their current health plan if they're fully insured. They're just not seeing them. And so I like to kind of picture it as a little bit of a puzzle sometimes, in that we have your medical plan is going to have a stop loss. You are going to have a TPA, which is a third party administrator. You're going to have a PBM, which is your pharmaceutical benefits manager, and then you're going to have a network. And those kind of four puzzle pieces is really what makes up your medical plan. One of the things that I love about captives is in self-funding is that if there's a piece of that puzzle that isn't working, we can simply replace just that one puzzle piece, not the whole plan. We don't have to worry about a complete change for the company and for the employees if just one part's not working. Maybe it is switching out the pharmaceutical benefit manager. Maybe it is some frustration with that TPA and we need to change it. One of the things that I love about working with you guys at Roundstone is you actually have your own in-house TPA called Bywater, and that makes it really seamless for clients that are transitioning from that are used to being fully insured to this model that you're providing. And this can be confusing, but through clarity and a process, we really try to make it seamless for those employers to go down this path and take the steps. So I think that that's helpful in how you broke that down. Is there anything else that you would want to add in regards to, how a medical captive can help our employers?
Yeah, I mean, it's really about, getting your data, paying what you deserve. A lot of groups are misaligned with the fully insured market, meaning they're not getting any data. They have no levers to pull at renewal. They're playing the 12-month merry-go-round, hoping that they don't get a big increase. And hope isn't really a strategy. So I think why groups are moving in this direction is, the market's, it never goes down. So I think employers are finally getting frustrated enough to look for alternatives. And there's a reason why big companies self-fund. It works. And it's really about getting access to your data and managing your claims. And why I partner with you a lot is that you're very proactive about staying on top of claims. And that's really where you're going to have a long-term success. This is a long-term strategy. Average group saving 19 to 20% a year, it adds up. So kind of getting off that merry-go-round, getting your own data, paying what you deserve, fully transparent. So aligning with, a low fixed cost model is important for employers to understand. The lower the fixed cost, the higher the opportunity you have to save. So.
Yeah, I appreciate that very much. And I agree, if we can work on controlling the claims, then we're going to be able to control the outcome of what this is going to be to not only our employers, but the members as well who are utilizing the plan. So I would say that if you are an employer, and part of our strategy is we meet you where you are, whether that's just exploring this option and you're not ready to act yet, we're here to help educate you along the way and be your partner in learning about these alternative funding structures. So here's the plan. It's really 3 steps. Step 1 is you need to evaluate your current plan and what your goals are so we know how we can try to work together to meet your goals. Step 2 is request a quote to see if a medical captive is the right fit for you. And 3, we will customize and launch your plan that is built with support, not only from now, but ongoing. And I think that those 3 steps are going to help you realize if you're going to choose to make a change now, or maybe it's even later, what is important to you. Sometimes we are taking on a fully insured group, meeting them where they are with an understanding of, hey, here's the ultimate goal that we want to achieve over time. It's more of a crawl, walk, run, and fly approach, I would say, to where you guys want to take your benefits and your strategy through your company. I think that healthcare doesn't have to feel like a black hole. With the right strategy and partners, and especially partnering with Roundstone, you can finally take control out of that. So if you want to see how this could work for your company, let's run a quick analysis. There's no commitment required. Just reach out and we'll schedule a consultation to have that done. Ryan, do you have any parting words on your end?
No, I think you said it very well. I appreciate the time, and I would say you are a very proactive advisor. So I value our partnership, and please reach out to Rachel for an analysis. So
awesome. Thank you so much, Ryan, for your time today. As always, it's a pleasure working with you and the Roundstone team. To anyone who is interested in learning about this next step, reach out to me and we'll connect. Have a good day.